What if you could predict crypto price moves before they even happen? Imagine looking at a chart and spotting signals that give you an edge, not by guessing, but by understanding how the market actually behaves. That's the power of technical analysis, and in today's video, we're breaking it all down in simple, practical terms. Whether you're brand new to trading or just looking to sharpen your skills, you're about to learn everything you need to know about technical analysis, what it is, why it matters in crypto, the tools traders use, the patterns to recognize, and the mistakes to avoid. By the end of this video, you'll have the knowledge to start reading charts with confidence and applying TA in your own crypto journey. Welcome to Crypto Education Zone. Let's dive in. Technical analysis, often shortened as TA, is the practice of studying price charts, patterns, and indicators to predict future movements in financial markets. In the world of crypto, this means analyzing how Bitcoin, Ethereum, or any other coin has behaved in the past, looking at their price action, market trends, and trading volume to make smarter decisions about when to buy, sell, or hold. At its core, TA assumes one simple principle. History often repeats itself. The way traders and investors have reacted to certain price levels in the past can give clues about how they might react again in the future. For example, imagine Bitcoin's price has bounced upward several times after hitting $20,000. A technical analyst might look at that level as strong support, meaning traders see it as a safe entry point. On the flip side, if the price has struggled to break above $30,000 multiple times, that level becomes resistance, where selling pressure usually outweighs buying pressure. By recognizing these patterns, TA helps traders anticipate where price could move next. Now, it's important to understand how TA differs from fundamental analysis, FA. Fundamental analysis looks at the bigger picture, the underlying value of an asset. In crypto, FA means studying things like the project's technology, its use cases, the team behind it, the size of the community, and adoption rates. For instance, Ethereum's value from an FA perspective might come from its role as the leading smart contract platform, powering decentralized finance, or DeFi, and NFTs. Bitcoin's fundamentals come from its scarcity, security, and status as digital gold. The key difference is this: TA focuses on price action, while FA focuses on intrinsic value. If FA is like looking under the hood of a car to see if the engine is strong, TA is like studying the road to figure out where the car is most likely to go next. Both are powerful, but they answer different questions. TA asks, when should I enter or exit a trade? FA asks, what is this asset truly worth? In crypto, successful investors often use both together. For example, FA might convince you that Ethereum is a strong long-term investment, but TA can help you time your entry to buy at a discount during a dip instead of buying at the peak of hype. This combination of big-picture fundamentals and short-term technical signals gives you a clearer edge in a volatile market like crypto, where prices can swing wildly within hours. So now you understand what technical analysis is and how it differs from fundamental analysis. One looks at the charts, the other looks at the bigger picture, and together they give us a complete view of the market. But here's the real question. Why does TA matter so much in crypto specifically? This market is unlike stocks or real estate. It's faster, more volatile, and often driven by emotion. That's why in the next part, we're going to break down exactly why technical analysis is such an important tool for crypto traders and investors, and how it can give you an edge in navigating this wild market.
Crypto is one of the most volatile markets in the world, and that's exactly why technical analysis plays such a crucial role here. Unlike traditional markets such as stocks, bonds, or even real estate, the price of a cryptocurrency can swing by double-digit percentages in just a single day, sometimes even in a matter of hours. For investors and traders, this volatility can feel overwhelming, but it's also where the biggest opportunities lie. Technical analysis gives you the tools to recognize patterns within this chaos, so you're not just reacting emotionally to sudden moves, but making decisions based on structure and data. For example, imagine Bitcoin drops 15% in a day. To someone without any knowledge of TA, this might look like the beginning of a complete crash, and the natural instinct would be to panic sell. But a trader using technical analysis might see this as a retest of a strong support level, or even a healthy correction in a longer-term bullish trend. Instead of selling in fear, they may prepare to buy at a discount, positioning themselves for the next upward move. Similarly, TA is equally valuable when prices are surging. During hype-driven rallies, many new investors get carried away by FOMO, fear of missing out, and buy at the very top only to see their investments collapse when the hype fades. Technical analysis helps protect against this by identifying overbought conditions, resistance levels, and warning signs that the market is about to cool off. This way, you don't get trapped in the frenzy, but instead know when to take profits or wait for a better entry. Another reason TA is so important in crypto is because the market is still relatively young and unregulated compared to traditional financial systems. That means prices are influenced heavily by sentiment, news, and sudden waves of buying or selling. Fundamental analysis, FA, like analyzing company revenues, assets, or industry position, doesn't always apply cleanly in crypto, since many tokens don't have traditional financials behind them. TA steps in as the universal language of market psychology, showing how crowds of traders react to fear, greed, and speculation in real time. Ultimately, technical analysis is important in crypto because it allows you to turn volatility, something that scares most people away, into a powerful advantage. By learning how to read charts, recognize patterns, and use indicators, you can start to see structure in the noise and make more strategic moves. In a space as unpredictable as crypto, having that edge is often what separates those who lose money from those who come out ahead. One of the greatest strengths of technical analysis is that it's universal. It works across Bitcoin, altcoins, and even meme coins. That's because TA isn't tied to the fundamentals of a project, but rather to the collective behavior of traders and investors. Whether you're analyzing a trillion-dollar asset like Bitcoin or a small-cap meme coin that just started trending on social media, the charts always tell a story. Price action reflects human psychology, and since fear, greed, and speculation drive every corner of the crypto market, the same principles of TA can be applied across the board. Take Bitcoin, for example. As the largest and most established cryptocurrency, its price movements set the tone for the entire market. Traders around the world use TA tools like support and resistance zones, moving averages, and trend lines to anticipate Bitcoin's next move. These same methods can then be applied to altcoins like Ethereum, Solana, or Cardano, where patterns often mirror Bitcoin but sometimes move with even sharper volatility. For instance, when Ethereum broke past key resistance levels in early 2021, it triggered a wave of excitement, leading to one of its biggest bull runs. Now, consider meme coins like Dogecoin or Shiba Inu. At first glance, these might seem impossible to analyze because they lack strong fundamentals and are driven almost entirely by hype. But surprisingly, TA is still very effective here. When Dogecoin surged in 2021 after Elon Musk's tweets, traders used chart patterns and volume analysis to spot when the rally was overheating. Those who paid attention to resistance levels and overbought indicators knew when to take profits, while those who ignored the signals often got caught in the sharp crash that followed. The key point is this: no matter what coin you're looking at, TA gives you a framework to cut through the noise. It doesn't guarantee perfect predictions, but it helps you identify high-probability setups and manage your risks more effectively. For Bitcoin, TA can guide long-term strategy. For altcoins, it can help you catch breakout opportunities. And even for meme coins, it can protect you from getting swept up in unsustainable hype. In short, TA works everywhere in crypto because the market, at its core, is driven by human behavior, and that behavior leaves patterns on the chart. Whether you're analyzing the king of crypto, a promising altcoin, or a viral meme token, the same principles of technical analysis can give you clarity in a market that often looks unpredictable from the outside. So now you can see why technical analysis is such a powerful tool in crypto. It works in every corner of the market, from Bitcoin to altcoins and even meme coins, because at the heart of it all, it's really about reading human behavior on the charts. But knowing why TA is important is just the first step. To truly use it effectively, you need to understand the core principles that guide every analysis, no matter what asset you're looking at. Let's move into the next section and break down those foundational principles of TA that every trader should know. At the heart of technical analysis are a few timeless principles that form the foundation of how traders read and interpret charts. The first is the idea that price reflects everything. This means that the current price of a cryptocurrency already includes all the known information, whether it's breaking news, investor sentiment, or even future expectations. For example, if Bitcoin suddenly drops on negative regulation news, that sentiment gets immediately baked into the chart. Traders don't need to chase every headline because the price itself becomes the ultimate summary of what the market believes at that moment. This principle allows analysts to focus less on predicting news and more on understanding what the market is already telling them. The second principle is that history repeats itself. Human behavior in markets tends to follow patterns because fear, greed, and psychology don't change over time. That's why chart patterns like head and shoulders, double tops, or bull flags show up again and again across decades of market data. For instance, the same bullish breakout pattern that appeared on Bitcoin in 2017 also appeared in altcoins during 2021. Different times, different assets, but the same emotional cycles playing out in price action. Recognizing these recurring setups allows traders to anticipate potential outcomes rather than feeling blindsided by market moves. The third principle is that the market moves in trends. Prices rarely move in a straight line. Instead, they flow in directional phases, uptrends, downtrends, and sideways consolidations. Spotting these trends early can be the difference between riding a profitable wave or fighting against it. For example, identifying a clear uptrend in Ethereum might encourage traders to look for buying opportunities during pullbacks, while recognizing a strong downtrend could help them avoid catching a falling knife. Trends give structure to the chaos of the market and provide a roadmap for making smarter decisions. Together, these three principles, price reflects everything, history repeats itself, and markets move in trends, create the foundation of technical analysis. They remind us that the market isn't random chaos. It's a system shaped by human psychology and repeated behavior, visible through charts. With this foundation in mind, traders can move forward into the specific tools and techniques that bring these principles to life. So now that you understand the core principles of technical analysis, that price reflects everything, history tends to repeat itself, and markets move in trends, you can start to see why charts are more than just lines and candles. They're a visual representation of psychology and cycles at work. But principles alone aren't enough. To put TA into practice, you need to understand the actual tools that traders use to read and act on these market signals. That brings us to the next step, the building blocks of technical analysis, the charts,
timeframes, and candlesticks that form the language of every TA strategy. When we talk about the building blocks of technical analysis, we're really talking about the foundation, the core tools that every trader relies on before diving into advanced strategies. The first and most essential element is charts and timeframes. In crypto, candlestick charts are the standard because they don't just show price, they also reveal the story of market sentiment within a specific period. Each candlestick shows the open, high, low, and close price, and when you look at them together, they form patterns that can hint at what might happen next. But beyond just looking at candles, the time frame you choose can completely change what you see. For example, a 1-minute chart might look chaotic, full of noise and tiny fluctuations, while a 1-day or 1-week chart shows the broader trend much more clearly. Shorter time frames are useful for day traders looking to capture quick moves, while longer time frames are essential for swing traders and investors who want to see the big picture. The ability to switch between these time frames is a skill in itself because it helps you understand both the short-term volatility and the long-term direction of the market. Another critical building block is support and resistance. These are the invisible lines on a chart that price tends to respect over and over again. Support is the level where price tends to stop falling and bounce back up, almost like a floor. Resistance is the opposite. It's the ceiling where price struggles to break through and often reverses downward. Identifying these levels is powerful because they act as decision points for traders. For instance, if Bitcoin has bounced off the $30,000 level multiple times in the past, that price becomes a major support level. If it breaks below that, it signals a possible shift in trend. Similarly, resistance levels help traders decide where to take profits, because price often stalls or reverses when hitting them. Think of support and resistance as the psychological barriers of the market. They're not random numbers. They represent where traders in the past have consistently bought or sold. This is why you'll often hear people say history repeats itself in trading, because these levels tend to remain relevant until the market decisively breaks them. By mastering charts, time frames, and support and resistance, you're learning the language of TA. These building blocks give you the ability to start interpreting market movements with clarity, rather than feeling overwhelmed by random price action. They are the stepping stones to everything else in technical analysis, from identifying trends to spotting patterns and using indicators. Trend lines and channels are another essential part of the building blocks of technical analysis because they visually capture the direction of the market. A trend line is drawn by connecting either a series of higher lows in an uptrend or lower highs in a downtrend. What makes trend lines so useful is that they help simplify what can otherwise look like chaotic price action. Instead of getting lost in the noise of small moves, a trend line shows you the broader direction the market is heading. When price consistently respects a trend line, it becomes a guidepost for traders. If price touches it and bounces, it signals the trend is still intact. But if price breaks through a trend line, it can be the first sign of a trend reversal. Channels are like an extension of trend lines. Imagine drawing two parallel trend lines that capture the highs and lows of price action. This creates a channel, and price often moves back and forth within it, like waves between two boundaries. In an upward channel, traders often look for opportunities to buy near the bottom line and sell near the top. In a downward channel, the opposite applies. Channels are powerful because they help you visualize both the direction and the range of price movement, allowing you to anticipate possible turning points before they happen. Volume analysis is the other major building block, and it's often described as the fuel behind price moves. Price can rise or fall, but without strong volume, meaning a large number of trades happening, those moves often don't last. High volume confirms that a trend or breakout is strong and supported by many traders participating. For example, if Bitcoin breaks above a key resistance level with low volume, it might be a false breakout, meaning the price could quickly fall back below resistance. But if that same breakout happens with a surge in volume, it's a stronger sign that the breakout is real and could lead to sustained movement. Volume also helps traders spot potential reversals. For instance, if price is rising but volume is steadily decreasing, it can be a warning that the uptrend is losing momentum and could soon reverse. On the flip side, if price is falling but volume spikes higher, it might suggest capitulation, a final wave of panic selling before the market stabilizes and reverses upward. Together, trend lines, channels, and volume analysis give you a much clearer map of the market. Trend lines and channels show you the path price is traveling, while volume tells you how much conviction and energy is behind that movement. Mastering these tools adds another layer of depth to your analysis, helping you avoid false signals and make decisions based on both price direction and market strength. So now you've seen the essential building blocks of technical analysis, from charts and time frames to support and resistance, trend lines, channels, and even the role of volume. These tools form the foundation of how traders read and interpret the market. But knowing the basics is just the starting point. To take your analysis further, traders often rely on a set of indicators and tools that help them measure momentum, strength, and potential turning points in the market. In the next part, we'll dive into the most popular indicators and tools that every crypto trader should know and understand. Moving averages are one of the most widely used tools in technical analysis, and for good reason. They smooth out price action to help traders identify the underlying trend. A simple moving average, SMA, takes the average of closing prices over a set period, like 50 days or 200 days, giving a clear picture of the general direction of the market. The exponential moving average, EMA, on the other hand, gives more weight to recent price data, making it more responsive to current market moves. Traders often use moving averages in combination. For instance, when a short-term EMA crosses above a long-term SMA, it's called a golden cross, which is usually seen as a bullish signal. Conversely, when the short-term line crosses below, forming a death cross, it often signals bearish momentum. In crypto, where trends can form and reverse quickly, moving averages provide a simple yet powerful way to filter out noise and stay aligned with the market's direction. The Relative Strength Index, or RSI, is another essential indicator that measures momentum. Unlike moving averages that focus on trends, RSI tells you whether an asset is overbought or oversold. It's calculated on a scale of 0 to 100, with readings above 70 typically suggesting overbought conditions, a potential signal that prices might pull back, and readings below 30 indicating oversold conditions, suggesting a possible bounce or reversal. For example, if Bitcoin has surged rapidly in just a few days and its RSI shoots above 80, traders might anticipate a short-term correction. On the other hand, if Ethereum crashes and its RSI dips into the low 20s, it could be a sign that selling pressure is overextended and a recovery might be near. However, RSI isn't foolproof. Strong trends can keep RSI overbought or oversold for extended periods, so the key is to use it in combination with other tools, not in isolation. Together, moving averages and RSI provide two different but complementary perspectives. One tracks the overall direction of the market, while the other highlights potential turning points caused by extreme sentiment. When used wisely, these indicators can help crypto traders cut through the noise and make smarter, more informed decisions. The MACD, or Moving Average Convergence Divergence, is a trend-following momentum indicator that helps traders understand shifts in momentum. It's built from two moving averages, the MACD line and the signal line, and the interaction between these lines often signals potential buy or sell opportunities. When the MACD line crosses above the signal line, it's commonly interpreted as a bullish signal, suggesting upward momentum. Conversely, when it crosses below, it indicates bearish momentum. Traders also pay close attention to the histogram, which shows the distance between the MACD and signal lines, making it easier to spot when momentum is strengthening or weakening. In crypto trading, the MACD is particularly helpful during periods of trend development, as it can reveal the early stages of reversals or confirm ongoing trends.
Fibonacci retracements are another favorite tool, based on the idea that after a significant price move, assets tend to retrace a predictable portion before continuing in the original direction. These retracements use the Fibonacci sequence to identify potential levels of support and resistance, typically the 23.6%, 38.2%, 50%, 61.8%, and 78.6% levels. For example, if Bitcoin rallies from $20,000 to $30,000, traders might look at the 61.8% retracement level to identify where buyers could step in if the price pulls back. These levels often align with psychological zones where traders expect reactions, making Fibonacci retracements especially useful in volatile crypto markets. They're not magic, but they can provide a roadmap for anticipating where price corrections might pause or reverse. Bollinger Bands, created by John Bollinger, are all about measuring volatility. The tool consists of 3 lines, a middle moving average, and 2 outer bands that expand and contract based on market volatility. When the bands widen, it signals increased volatility, while narrowing bands suggest consolidation or a potential breakout brewing. Traders often use Bollinger Bands to identify overbought or oversold conditions. If the price repeatedly touches the upper band, it may be overbought, and if it hugs the lower band, it may be oversold. In crypto, Bollinger Bands are especially valuable because breakouts from periods of tight consolidation often lead to sharp moves. For instance, if Ethereum's price has been squeezing tightly between the bands, traders may prepare for a significant breakout. Though the tool doesn't predict direction, it just signals that a big move is coming. Together, MACD, Fibonacci retracements, and Bollinger Bands offer a strong toolkit for crypto traders. MACD reveals momentum shifts, Fibonacci maps potential retracement zones, and Bollinger Bands track volatility. When combined, they create a more complete picture of where the market stands and where it might be headed next. So now you've seen how indicators like moving averages, RSI, MACD, Fibonacci, and Bollinger Bands give us valuable signals about momentum, strength, and volatility. But numbers and indicators are only half the story. The other half lies in visual patterns that repeat themselves on the charts and reveal the psychology of buyers and sellers. That's where chart patterns come in. And if you understand them, you'll be able to spot opportunities long before most traders do. Let's move into the next part, the chart patterns you must know.
Chart patterns are like the fingerprints of market psychology. They show us how traders are behaving and often hint at what might come next. One of the most famous is the head and shoulders pattern, which typically signals a reversal. Imagine a chart that rises to a peak, the left shoulder, then dips, rises higher, the head, dips again, and then rises but not as high, the right shoulder. When the neckline breaks, it often suggests that the trend is about to reverse downward. The inverse version works the same way, but points to a potential upward reversal. Traders love this pattern because it's relatively easy to spot and has been proven over and over to play out reliably. Next, we have double tops and double bottoms, another classic reversal pattern. A double top happens when price hits a high, pulls back, then tries again to break that high but fails, forming an M shape. This often signals weakness and a potential drop. A double bottom is the opposite. Price tests a low twice but refuses to break lower, forming a W shape that signals potential upside.
These patterns are like the market testing its limits, and when it can't push further, it often turns in the other direction. Then there are triangles, which represent consolidation phases, where price is squeezing tighter and tighter before a breakout. An ascending triangle forms when highs are horizontal, but lows keep getting higher, showing buyers are becoming stronger and often leading to an upward breakout. A descending triangle is the mirror image, often leading to a breakdown. A symmetrical triangle shows price coiling, with both lower highs and higher lows like a spring being compressed, until it explodes in one direction. The trick for traders is to wait for the breakout before jumping in. Finally, flags and pennants are continuation patterns that appear after a strong move. Picture a big bullish run upward. Instead of crashing back down, price consolidates in a small downward sloping flag or a tight triangular pennant. These patterns usually mean the market is just catching its breath before continuing in the same direction. Flags and pennants are powerful because they help traders spot when a trend is pausing rather than reversing. The beauty of these patterns is that they don't just show lines on a chart, they represent the emotions of traders. Head and shoulders shows exhaustion, double tops and bottoms show failed breakouts, triangles show building pressure, and flags show a strong trend taking a break. Mastering them means you're no longer guessing, you're reading the psychology of the market in real time. So, now you can see chart patterns aren't just shapes on a screen. They're stories about how traders think and react in the market. When you recognize these stories, you can spot opportunities that many others miss. But here's the catch. Knowing the patterns is only half the battle. Many traders fall into common traps when applying technical analysis, and those mistakes can turn good setups into painful losses. That's exactly what we're diving into next, the mistakes you need to avoid in TA. One of the biggest mistakes traders make in technical analysis is over-relying on indicators. It's easy to think that adding more tools to your chart will give you more accuracy, but in reality, it often creates confusion. For instance, a beginner might stack 10 different indicators, moving averages, RSI, MACD, Bollinger Bands, and more, hoping to find the perfect signal. But when one says buy and another says sell, the trader ends up paralyzed or making poor decisions. The truth is, no indicator is foolproof. They're only guides. And the more you depend on them without understanding the bigger picture, the more likely you are to make mistakes. Smart traders often focus on just a few reliable tools and combine them with price action and context to make informed decisions. Another common pitfall is ignoring bigger time frames. Many new traders get caught up in the excitement of lower time frames, like the 1-minute or 5-minute charts, because the price moves so quickly and feels action-packed. While these can be useful for scalpers, they often give false signals and can mislead you about the broader trend. Imagine seeing a bullish signal on the 5-minute chart, but the daily chart shows a clear downtrend. Jumping into that trade could be a costly error. Successful traders always zoom out first, looking at daily, weekly, or even monthly charts to understand the dominant trend, then zoom in to refine their entries and exits. It's like navigating with a map. You wouldn't zoom in on one street without first understanding which city you're in. The third mistake is letting emotions override signals. Technical analysis only works if you follow the data instead of your feelings, but fear and greed are powerful forces. For example, you might see a bearish reversal pattern forming, but because you don't want to admit a potential loss, you ignore the signal and hold on, only to watch the price drop further. On the flip side, you might see an overbought RSI that suggests caution, but greed convinces you to ride the wave, and you end up buying right before a reversal. Emotions turn logical setups into impulsive decisions, which is why discipline is the backbone of TA. Having a plan, setting stop losses, and sticking to your strategy help keep emotions in check. Avoiding these mistakes is what separates consistent traders from the rest. Indicators, timeframes, and emotions are tools and factors you must master, not let control you. By keeping your analysis clear, respecting the bigger picture, and staying disciplined, you'll avoid the traps that cause most traders to fail. So now you can see that avoiding mistakes in technical analysis isn't just about knowing what to look for. It's about knowing what not to do. Overloading your charts with indicators, ignoring the larger time frames, or letting emotions dictate your trades can completely sabotage your results. Once you eliminate these bad habits, the real power of TA starts to shine through. And that brings us to the next step, how to actually use technical analysis effectively. In the next section, we'll explore the strategies and best practices that turn TA from just theory into a powerful tool you can apply in real trading.
Using technical analysis effectively isn't about simply recognizing patterns or throwing indicators on a chart. It's about turning those insights into a disciplined trading plan that keeps you safe while giving you the chance to grow your portfolio. The first step to making TA work is combining it with risk management. Even the best setup can fail, and that's where tools like stop-loss orders come in. A stop loss ensures that if the market suddenly moves against your trade, you automatically exit before your losses spiral out of control. This small safety net can make the difference between staying in the game or blowing up your account. Another key part of risk management is position sizing. Too many traders throw all their money into a single trade because they feel extra confident about it. But that's a dangerous habit. Instead, smart traders decide ahead of time how much of their capital to risk per trade, often no more than 1 to 2%. This way, even if several trades go wrong in a row, they still have plenty of capital left to keep playing the long game. Think of it like a marathon, not a sprint. Technical analysis helps you spot potential opportunities, but risk management ensures you survive long enough to benefit from them. When you bring these two elements together, technical insights and disciplined risk control, you stop trading based on hope or gut feeling. Instead, every move you make has a plan, a safety net, and a strategy behind it. That's the foundation of using TA effectively. Not just reading the charts, but also protecting yourself from the unpredictable nature of crypto markets. Another way to maximize the effectiveness of technical analysis is by using multiple indicators for confirmation. No single tool or signal should ever be trusted in isolation, because markets can produce false signals that trick traders into bad decisions. For example, the RSI might show that Bitcoin is oversold, suggesting a bounce could happen. But if the moving averages are still pointing sharply downward with high volume selling, that's a sign the downtrend may not be over yet. By combining indicators, like using RSI alongside MACD and volume, you filter out weak signals and increase the probability of making stronger, more informed trades. Think of it like building a case in court. The more evidence you have pointing in the same direction, the more confident you can be in your decision. That said, there's a danger in going too far. Many new traders fall into the trap of overloading their charts with every indicator they can find, hoping that more tools automatically mean better accuracy. In reality, too many indicators can create confusion, conflicting signals, and paralysis when it's time to act. The best traders often keep things simple: a few reliable indicators, a clean chart, and a focus on the core signals that matter most. Simplicity leads to clarity, and clarity leads to better decisions. So technical analysis is about striking the right balance, using multiple tools for confirmation, but not so many that you drown in information. The goal is to read the market with confidence, stay disciplined, and avoid letting noise distract you from the big picture. Technical analysis isn't a magic crystal ball, and it will never predict the future with 100% certainty. What it does give you is an edge, a way to shift the odds in your favor by analyzing probabilities instead of acting on emotions or guesswork.
Every chart, pattern, and indicator is a tool to help you make smarter, more disciplined decisions in a market that thrives on volatility. The real value of TA lies in preparation. By studying trends, identifying key levels, and confirming signals, you move from reacting blindly to trading with intent. You won't win every trade, but you'll avoid the emotional traps that cause most people to lose. Over time, those consistent, probability-driven decisions are what separates successful traders from the rest. So as you move forward, keep this in mind. TA isn't about being perfect, it's about being prepared. The market will always have uncertainty, but with technical analysis, you can navigate it with clarity and confidence. At the end of the day, technical analysis is a skill, and like any skill, you only get better by practicing. Watching videos like this gives you the foundation, but the real growth comes when you open up a chart, apply the tools, and see how the patterns and indicators play out in real time. Don't just be a spectator. Put what you've learned into practice, make mistakes, learn from them, and refine your strategy. That's how you turn knowledge into experience. And if you want to keep sharpening your edge, make sure to subscribe to Crypto Education Zone. We're here to guide you with clear, practical lessons that cut through the noise and help you trade smarter. Hit the notification bell so you never miss the next insight, and join a community of learners who are serious about mastering crypto trading. Thank you for watching. See you on the next video.